So in this particular lecture, we'll be discussing about the fourth unit of the fourth chapter, that is going to be the exchange rates and their effect. So this I had left out last time because of the time constraint. This unit is particularly a little bit lengthier unit than the other ones, and more of theory as well. So let us go through each and everything, and let us understand what this chapter wants to communicate with us. So the name of the unit is exchange rate and its economic effects. And we are going to learn this on a broad basis in three different sectors. First part, we are going to learn the exchange rate regimes. Second, we are going to learn changes in exchange rates and how they occur. And third, we are going to learn concepts like these devaluation versus depreciation, etc. Right? So let us get to it. The exchange rate. What do you mean by a exchange rate? A foreign exchange refers to money dominated in a currency other than the domestic currency. So we live in India, and of course, uh, right. So we live in India, and we go through or we use currency such as rupee, right? And the person who is living somewhere else, right, in America, right, he uses American dollars. Australia, they use Australian dollars, right? And so many countries use different currencies, and all for them, any currency that they deal with other than their home currency is called as foreign currency. It's as simple as that, right? And similar to any other commodity, foreign exchange has a price. Okay. Usually, this chapter is looked at as a difficult chapter in CA final SFM subject, right? The foreign exchange and its related concepts are considered to be a little confusing and difficult. The reason for that is in every subject that we have learned, there is a product and there is a price. But in subjects like foreign exchange, the product is the price itself, product is a currency, as well as the price is a currency. So you are exchanging currency for currency. That is why a little bit of confusion creeps in here. But all this confusion can be made, you can make that go away if you start naming that product currency as a product itself rather than a currency. For example, instead of calling dollar a dollar, if I start calling dollar a chocolate, then I can easily ask you the price. How much does one chocolate cost? Rather than asking you how much does $1 cost, right? So rather than giving the relationship between dollar and rupee, now we will be giving a relationship between the chocolate and the rupee, which you usually do in our day-to-day activities, right? So that is where the total confusion can be brought down to a maximum level. Now in this chapter, in this unit, we are going to learn not much about the calculation of currency, exchange rates, how do they come and all that. We are not going to calculate that. Only theory based on that is given, and what across the world different countries follow, that data is also given to us. Now see, the exchange rates around the world are expressed in one of the two ways. The first way is called as a direct quote or direct quotation. Like, what is a direct quote? A direct quote is a number of units of a local currency exchangeable for a unit of foreign currency, right? So basically what I'm trying to say is, if I say that $1 costs 76 rupees, I am telling how much does one unit of foreign currency cost in my local currency, right? So that kind of a quotation is called as a direct quotation. Okay. And direct quotation looks at the foreign currency like a commodity itself, because I give the unit price of that commodity, right? And this direct quote is also called as European currency quotation, right? Now, in this, the foreign currency will be the base currency because for which the price is given, and the domestic currency is called as a counter currency, right? The price of that foreign currency is countered by giving local currency, right? $1 is equal to 76 rupees, or $1 is equal to 80 rupees. Next, we have something called as indirect quotation. Now, indirect quotation is also called as the American currency quotation. Now, what happens here? In an indirect quote, the number of units of foreign currency exchangeable for one unit of local currency is calculated. The example for that is 1 rupee is equal to $0.0151, right? So you are expressing the price of your home currency here, which is a base currency. The domestic currency is a base currency, and foreign currency is the counter currency. Now, which is the most famous among them? Definitely, the direct quotation is the most famous among them. There are very less countries, including UK, which follow indirect quotation, and there are very less countries actually which go through this kind of currency quotation. Next, we have something called as cross rate. Now, what is cross rate? See, there is a direct, or say there is a quote between Indian currency and US currency, right? And there is a quote between, let us say, US currency and certain African countries currency, okay? And Indian currency and that African currency doesn't have a direct quote or any kind of a quote for that matter. In that case, what does India has to do if it has to get that African currency when there is no quote at all? You have to first buy dollar, and after buying dollar, use that dollar to buy that African currency, right? Hence, here a cross rate is calculated where the quotations are not given directly, right? In that case. So these are the 2-mark questions which are possible. They might ask you which are the different kinds of quotes you might have to write, direct and indirect quote. And they can also ask you for 2 marks, what is cross rate. Next, let us go into the another important section there that is called as the exchange rate regime. Now, what do you mean by exchange rate regime? All around the world, on a very broad perspective, there are two different types of the how the exchange rates are determined. Okay, one is called as floating exchange rate regime, and second one is called as fixed exchange rate regime. Now, in floating exchange rate regime, what happens? Simple. Under floating exchange rate regime, the equilibrium value of the exchange rate of a country's currency is market determined, which means whether $1 is going to be 70 rupees or $1 is going to be 75, $1 is going to be 80 rupees. Who will decide it under floating rate regime? The market determinants, that is the demand and supply for that particular currency. Simple, the x-axis, y-axis, demand curve, supply curve, equilibrium, right? So the demand and supply will decide. There is no interference by the government or the central bank of that country, which means that in Indian case, right, the government of India and the RBI will not, interfere in how this price is being determined. Whether it is the actual case about India, we are going to see in certain time. But understand that under floating rate regime, will the government and central bank interfere? Answer is no, right? Next, there is a fixed rate regime. What do you mean by fixed rate regime? It is also referred as pegged exchange rate. Is an exchange rate regime under which a country's central bank and or the government announces or decrees what its currency will be worth in terms of either another country's currency or a basket of currencies. Okay, what happens here? Imagine this happens tomorrow. India comes up with and says that $1 is going to be 75 rupees, and no market forces will determine what the price is, right? Whenever you say that, it becomes a fixed exchange rate regime, right? It is also called as what? Pegged exchange rate. Here, there is a complete interference of the government and the central bank as to how the price is determined. They themselves are going to determine the price based on certain aspects which are beneficial for their countries. So there are two major, regimes, right? Or how the price of the foreign currency is determined. One is floating rate regime, where demand and supply will decide, and next one is fixed rate regime, where the government or the central bank will decide. And we have International Monetary Fund classifications and definitions of exchange rate regimes, right? We looked at two extremes. One is floating rate regime, and the second one is fixed rate regime. But in between, there are so many different arrangements, and IMF has classified and defined these kind of exchange rate regimes, which are including these extreme ends, that is floating and fixed. and between there are different kinds of arrangements or kinds of combination among them, right? So we are going to learn that. First one is the exchange arrangements with no separate legal tender. Now this means that this country, these are usually the small countries or islands which are there. Now they don't have their currency at all. Their official legal tender is dollars. They consider US dollars to be their currency, and they do their business in that particular currency itself, right? US dollars. This is called as exchange arrangements with no separate legal tender. Next, we have something called as currency board arrangements. This is nothing but the fixed rate which we are talking about. The monetary regime based on implicit national commitment to exchange domestic currency for a specified foreign currency at a fixed exchange rate. Example is given of Hong Kong, right? Dominica, Grenada, right? And here what happens, the fixed rate is decided, okay, for a particular currency which is foreign basket of currencies. Next we have other conventional fixed peg arrangements. There are around 43 countries which are following that. A country pegs its currency at a fixed rate to a major currency or a basket of currencies where exchange rate fluctuates within a narrow margin or at most plus or minus 1% around the central rate. Here is also it is fixed, right? The rate is fixed, but the fluctuation allows for a narrow margin of plus or minus 5%. Oh, sorry, 1%. It can go up by 1 or it can go down by 1. There are many countries which follow this, right? And why do they have such arrangements? There could be different reason. It could be a reason of their own betterment of a country, or the government over there thinks that it is beneficial for their country, right? There are countries like Oman, Qatar, Saudi Arabia, UAE, and all these countries have this particular arrangement. Next, we have pegged exchange rates within horizontal bands. Now, value of the currency is maintained within margins of fluctuation around a formal or de facto fixed peg that are wider than 1% around the central rate. Okay, here it's a very little difference between the conventional peg and with horizontal bands. Here, the fixed peg is decided and the rate will fluctuate more than 1%. Okay, it can fluctuate more than 1% as well, right? And there is only one country which follows that. Next, we have something called as crawling peg. Now, what is crawling peg? Currency is adjusted periodically in small amounts at a fixed pre-announced rate in response to changes in certain quantitative indicators. Now, here, the currency will have a fixed peg, and from that fixed peg, you will change periodically. That is, it could be 1 week, it could be 1 month, it could be 3 months. Periodically, you're going to change in small amount at a fixed pre-announced rate, which means that how much you're going to change the price, that is also pre-decided. Okay, it could be 0.25, right? Or it could be 0.5. So you're going to increase or decrease. That is a decision government has to make based on certain quantitative indicators, right? But here also a fixed peg is there, but the changes are made in small amounts at a fixed pre-announced rate. That is a very important feature. Next, there are crawl-like arrangements. So here what happens, currency is maintained within certain fluctuations margin, let's say 1 or 2% around the central rate, that is adjusted periodically. And here also it is somewhere close to crawling peg, but only difference is in crawling peg what used to happen, both crawling peg and crawl like arrangements are adjusted what periodically, that is similarity between them. Okay, but in case of crawling peg what happens, the change which is going to happen after a certain period is pre-decided, whether it is going to be 0.5. 0.5 is decided, whether it will go up or down, that has to be decided. Whereas in crawl like arrangement, they are given percentage. It can be 0.5%, and it's usually 1 to 2%. That's what they are telling. So this fixed pre-announced rate is not there, right? This fixed pre-announced rate is not there in crawl like arrangement. Then we have here there is some print error. It has to be other managed floating. Okay, managed floating. Managed floating means managed floating is what Indian rupee follows, right? Indian rupee, for the most part, it is floating, but because the currency is not matured enough, the central bank has to support it by intervening in the foreign currency market once in a while, right? So they will enter, they will see how much of the results they have got and what kind of decisions they can make, right? They will not let it completely decided by the demand and supply because the currency is not mature, the economy cannot handle that stress, right? Next, we have free floating. There are 31 countries which are there, such as US, Canada, Japan, New Zealand, UK. Free floating, we already know the exchange rate is what? Market determined, which means that the demand and the supply will decide the price of the currency. Next, let us go ahead and learn the next part. We have learned the IMF classification. So now what are we going to learn? The advantages of a fixed rate regime. Why countries, go for fixed rate regime? We have seen that there are so many countries, either they are coming under that currency board arrangements, which are, literally fixed, or they're coming somewhere around the, a little bit of work around the fixed peg, right? So why do countries do that? Let us learn it. A fixed exchange rate avoids currency fluctuations and eliminates exchange rate risk, okay, and transaction cost that can impede international flow of trade, right? So every day the currency is getting, the price of the currency is getting decided in the market. It is so much stress, right? And here what happens? The fluctuation leads to less attraction towards a particular country. If the country's currency keeps on changing, right, the investors will not be interested much unless and until it what to say, if I'm a foreign investor investing in a country, I would like that country's currency to appreciate rather than depreciate. Okay, so I will have my what to say, the concerns about what could happen to that currency of that particular country if I have a foreign investment. But if there is a fixed peg arrangement, if there is a fixed exchange rate, I don't have to worry, right? That is a point. Next, a fixed exchange rate can thus greatly enhance international trade and investment because it provides something called a stability, right? So there is no change in the exchange rate at all. $1 is equal to 75 rupees, no matter what happens. How much demand, how much supply, we are not going to change, right? A reduction in speculation on exchange rate movements if everyone believes that exchange rates will not change, right? So what happens? Speculation will stop. We know that foreign exchange market is one of the biggest markets. There are people who just trade in foreign currencies and make millions of dollars, right? So that is called a speculation. What would happen, right? So that speculation will completely stop if you go for fixed, peg. Next, a fixed exchange rate system imposes discipline on country's monetary authority. Okay, so first of all, it will take a lot of headache of the monetary authority because the rate is fixed and you don't have to keep watching the market to see what how much demand has come, how much supply is there, and all that data. You don't have to take it on real time basis to make any decisions because the currency rate is fixed. The government can encourage greater trade and investment as stability is there. I've already told you. The exchange rate peg can also enhance the credibility of country's monetary policy. Now, however, in the fixed or managed floating exchange rate regimes, where the market forces are allowed to determine the exchange rates within a band, a central bank is required to stand ready to intervene in the foreign exchange market and also maintain an adequate amount of foreign exchange reserves for this purpose. Now, what happens in India? We have something called as managed floating. What do you mean by managed floating? See, today the demand and supply is properly meeting their ends and the exchange rate is not destabilized to a maximum extent. But tomorrow some speculators come, and after the speculators come, what they do? They try to trade in the dollars, and they will raise a very high demand for dollars in India. And when they do that, right, what will happen? If the demand is more for a commodity, the price will increase. That is, the home currency will depreciate, foreign currency will appreciate. Now there, the central bank has to intervene immediately because like the matured markets such as US and Canada and all that, we do not have that that resistance to hold on for that big speculation demands and all that. That is where the central bank comes into picture, and central bank will bring foreign reserves. They maintain a lot of foreign reserves, foreign exchange reserves, for this purpose, to make sure that if something goes wrong, if some unexpected thing happens, we have enough reserve to either supply for the demand, right, or buy from the market if there is a lot of supply, right? Next, what are the advantages of a floating rate regime? Let us look at that. Floating rate regime, in the sense I already told you, that is what will decide the demand and supply. uh, yeah, the class is going to be up till around 10. Okay, you can say 1 hour it might go on. So question had come. Now, what are the main advantages of floating rate regime? I told that who will decide the price in floating rate regime? It is demand and supply. A floating exchange rate has the greatest advantage of allowing a central bank or government to pursue its own independent monetary policy, right? If the rate is fixed, you don't have a policy for exchange rate at all, because rate is fixed by the government or central bank. But wherever there is floating rate, a central bank or a government can form policies and they can see their effectiveness. Next, floating exchange rate regime allows exchange rate to be used as a policy tool. That is, example, policymakers can adjust the nominal exchange rate to influence the competitiveness of tradable goods sector, right? A lot of effect is there whenever a country is involved in international trade. The changes in the exchange rate, it works as a real, what to say, uh, one of the major factor in deciding how much money is made, how much receivables are there, how much payables are there, right? All these things are highly depending upon the exchange rate when a company is depending upon exports or imports. Now, because of this, right, what happens whenever a country wants to give a boost to the export sector or import sector, in that case, the policymakers can adjust the rates and see changes, right? Next, there is no obligation or necessity to intervene in the exchange market. So now this is not for managed floating. This is for fully floating, like US dollars. In that case, the central bank of US need not maintain huge foreign exchange reserves because they don't have to intervene in the market. Now, that is regarding the advantages of floating rate regime. These two are very important questions. So mark them as important. That is advantages of fixed rate and advantages of floating rate. Next, we have something called as the nominal versus real exchange rate. Now, let me tell you this. Imagine that $1 is equal to 100 rupees. Now, when I say $1 is equal to 100 rupees, what I can buy in USA with that $1, can I buy the same thing in India for 100 rupees? That question will come into question, right? So when $1 is equal to 100 rupees in the market, will I get the product which I get at $1 in US for 100 rupees in India? That is not possible, because the value of that $1 to the value of the rupee, that is 100 rupees, is pegged in the exchange rate market, or it is decided in the exchange rate market with the help of demand and supply, need not be the actual value which it will be used in the goods and service market of a country. Okay, we have a lot of examples like that. We have similar company goods which are traded in the US market and they are traded in Indian market. But when they are traded in US market, what happens? They are sold for, let us say, $100, and $100 into 100 rupee, that is going to be the exchange rate that I'm going to take for this purpose. 100 into 100 is 10,000 rupees. So what I get for $100 in US, will I get for 10,000 rupees in India? The same company, the same product? Answer is no. There is going to be price difference. Okay, and I'm not talking about the price difference which is because of taxes, right? I'm talking about the pre-tax price. Okay, whether that is going to be same. Okay, answer is no. That is because the rate that we see in the market, or when you Google, right, you get know how much is $1 is equal to, that rate is called as nominal exchange rate. that doesn't represent the actual real value that currency holds in buying goods and services. For that, you have to calculate something called as real exchange rate, right? Real exchange rate is a rate at which a person can trade the goods and services for one country for the goods and services of another. It describes what? How many of goods and services of one country can be traded for one of that good or service in a foreign country. Okay, and how do we find out real exchange rate? It's simple. Nominal exchange rate multiplied by domestic price index divided by foreign price index. Okay, that is a formula for it. Next, we have to study something about the foreign exchange market. Okay. Now, I'm not going to cover much about this because it's not very important. You can read it once, right? And for the purpose of exam, they might ask a short note on foreign exchange market, but very less possibility. So that if you read it once, that's more than enough. And coming here to the next part, I will just cover this particular part. In foreign exchange market, there are two types of transactions. The first type of transaction is called as current transaction. Current transactions are also called as the spot transactions, where what do you mean by spot transaction? I want to buy something, right? And I have bought it today, right? And when I want it, and the delivery is done immediately. Okay, spot market, the current transaction. Okay, and the second type of transaction is called as future transaction. You know what future transaction is? Future transaction means I want to transact something after 6 months, but for that I'm fixing the price today, right? Let me give you an example. Imagine that I have imported a machinery from US and I have to pay $10,000. But this $10,000 I have to pay after 6 months. Okay, that is the what me and the seller agreed. Okay, I will send $10,000 after 6 months. Now, in that case, I can't wait for 6 months to buy those $10,000. I have to first buy those $10,000 to pay him, right? So where will I go to buy it? I go to the bank. And what will I say? I say that, see, I want $10,000 after 6 months, but let us fix the price today. Okay, we will fix the price today, and after 6 months, I'll give you that price, and let me take that $10,000. Okay, so that is how you fix the price, and these kind of transactions are called a future transactions. Okay, next, determination of nominal exchange rate. Now here I have nothing to say because the graph is very clear. The determination of nominal exchange rate happens how? It happens based on demand and supply, right? So demand curve, supply curve, intersection, that's the quantity and the price, right? To the x-axis and to the y-axis. It's much easier that way. Next, let us understand when I say demand, right? There is a demand for currency. Why people demand for foreign currency? That question will come. This question is an important question from examination point of view, right? People desire foreign currency too. Okay, mark that important. Why do they want? First, purchase goods and services from another country for unilateral transfers, such as gifts, awards, right? There are 2 points which are mixed over here. The first point is here, the purchase of goods and services from another country, right? So there are a lot of people who import a lot of equipments, electronics, and whatnot from outside the country. Not only the industrialists or producers, even customers like us, right? Sometimes we find certain equipments or electronics to be good quality over the foreign country, and we import it, right? That is one. Second, there is for unilateral transfers such as gift, awards, grants, donations, and endowments. Right? Whenever there is a lot of poor countries around the world, and there are certain organizations which collect a lot of donations to support them, and there are a lot of Indian people, philanthropists who give this money as grant, donation, or endowment. Those are called unilateral transfers without expecting something else in return. Next, to make investment income payments abroad, like somebody has put money into your business, a foreign investor. Now we are paying him. While you are paying him, you can't pay in rupee, you have to pay in his currency. It's going to be dollar or whatever. Next, to purchase financial assets, stock or bonds, you want to purchase Apple stocks, right? Your Apple shares, Facebook shares, you have to buy that in foreign currency. Next, to open a foreign bank account, of course, in foreign bank account, you can't put Indian rupee. To acquire direct ownership of real capital, that is to buy houses in Europe or US, and if you have this dream, you can't pay in rupee. So that you need euros, you will raise demand for euros for speculation and hedging activities, etc., which will happen. Now, see this thing is given over here. The demand curve is given, the supply curve is given, the equilibrium quantity is here, equilibrium price is here, right? So this is how price is determined in the market. Next, changes in exchange rates. Now, this is a very important concept, right? Uh, we tend to use the words very loosely, okay, sometimes. But in economics, it is said that there are certain words which are associated with certain concepts, such as if you are using floating rate regime, whenever your currency rate changes, the terminology that you're supposed to use is appreciation and depreciation. Okay. So today, dollar price was, let us say, 75, and tomorrow it became 77. It means that rupee depreciated. All right. Rupee depreciated in its value. Why? Because earlier 75 rupees could get me $1. Now I have to pay 77 rupees to get that same dollar. Right. So the rupee depreciated. And if that price $1 is equal to 75 becomes $1 is equal to 70, then the rupee appreciated. That is what we use. Of course, when I say about home currency, I say whether home currency depreciated or home currency appreciated, which means it becomes opposite in foreign currency, right? When home currency depreciates, foreign currency appreciates, and when foreign currency depreciates, home currency appreciates. It's as simple as that. Now, there are two different things over here. Home currency depreciation, right? Same as foreign currency appreciation they have written. And home currency appreciation, which is same as foreign currency depreciation, right? And we have given over here how does the home currency depreciates. Of course, home currency depreciates because the demand for the foreign currency is more, right? So what happened? Demand curve is over here. First it was D, then the demand went up and became D1, and the new equilibrium was here in E1, and with that what will happen? The price increased. So that this is what happens in um, home currency depreciation. Next, the home currency appreciation is also shown. That is what happened. The supply of dollar increased. When the supply increases, definitely the price of dollar will decrease, right? So S became S1 and the new equilibrium from E to E1 and the price has dropped. Okay, this is how changes happen in floating rate regime. Next, whenever you are using, the terminology for fixed rate regime, you are supposed to use either revaluation or devaluation. Okay. So if I was pegging Indian rupee in a fixed rate regime, and I say that $1 was equal to 75 rupees, and now $1 became 80 rupees. In fixed rate regime, it would be called as devaluation. Okay, it is not called as depreciation. Depreciation is the terminology used for floating rate regime. And when the home currency, let us say $1 is equal to 75, became $1 is equal to 70 in fixed rate regime, that is called as a revaluation instead of appreciation. Okay, you have to remember that. Next, what are the impacts of exchange rate fluctuations on domestic economy? That is a question. And for that, it can be a direct question. What is the impact of foreign rate fluctuations? And I've given several reasons for it. I've given several points. You have to remember any of the 4 points properly. And you have to read all the points because any of this one single point can be a question. Okay. Now, the developments in the foreign exchange market affect the domestic economy both directly and indirectly. We know that the exchange rates have a very significant role in determining the nature and extent of country's trade. Changes in import and export prices will lead to changes in import and export volumes, causing changes in import spending and export revenue, right? So a lot of changes, right? A lot of companies in a country will depend upon import and export. So there will be a big change whenever there is a change in the exchange rates. That is why it is taken up as such an important issue, and so many debates and discussions you can see whenever the currency starts appreciating or depreciating fast. Fluctuations in exchange rate affect the economy and by changing the relative price of domestically produced and foreign produced goods and services. All else equal, an appreciation of the country's currency raises the relative price of its exports and lowers the relative price of its imports. Right? What do you mean by appreciation? $1 is equal to 75 became $1 is equal to 70. Now, what will happen to an exporter? Earlier, he had a receivable of $10,000. Now, for every dollar, you would have received 75. Because your currency appreciated, now will receive only 70. So, for him, there is a reduction, okay, in revenue. But for the importer, what will happen? Importer, I have to pay $10,000. So, earlier, I had to buy dollar at 75 rupees and pay him. Now I have to buy dollar at only 70 rupees and pay him. So, I'm going to save. So, whom it will benefit? The importer. The home currency appreciation will benefit the importer and will put the exporter in what to say, a kind of a trouble there by revenue loss. Next, exchange rate changes affect economic activity in the domestic country. A depreciation of a domestic currency primarily increases the price of foreign goods and all that, we know it. By lowering the export prices, the currency depreciation increases the international competitiveness of domestic industries, right? The volume of exports and promotes trade balance, correct? We have seen above that changing in the relative prices, depreciation may increase windfall profit. Okay, what is windfall profit? Let me explain. Imagine that you had a receivable of $10,000 from US at the rate of 75 when you actually made the sale. So you were supposed to receive, let us say, 7.5 lakh. But suddenly what happened? The price, the Indian rupee depreciated and $1 is equal to became 80, right? $1 is equal to 80. In that case, now your receivable became how much? 8 lakh, right? Sudden 50,000 profit. But for this 50,000, what did you do? You didn't do anything. Everything happened because of exchange rate fluctuation. Now, whenever you make this profit because of exchange rate fluctuations, we call that profit as windfall profit. Okay, and that happens whenever there is depreciation of home currency. And I given rest of the points. There are 8 points. Read them all. Remember 4, and any point can form a question. Now, other impacts of foreign depreciation are given over here. And its windfall gain, I've already told you. Remittances to homeland by non-resident and businesses abroad fetches more in terms of foreign currency, right? So whoever is sending money, if your relatives are there in Gulf countries or Europe or US, they're sending money. If the home currency, that is Indian rupee, depreciates, they will get more money when they convert that into Indian currency, right? Because they have foreign currency. Next, see, here we are not talking about advantages or disadvantages. We are talking about the impact. Okay, you have to understand that impact can be positive to our country, impact can be negative. Impact is an impact. What affects? Okay, that's what we are learning. Now, depreciation would enhance government revenues from import related taxes. Okay. Then depreciation would result in higher amount of local currency for a given amount of foreign currency. Then depreciation also can have a positive impact on country's trade deficit as it makes imports more expensive for domestic consumers, right? So if you don't import, the foreign currency will not go out, right? So the demand for foreign currency will come down. So that is the argument here. Depreciation can also have a positive impact on controlling spiraling gold imports, mostly wasteful, and thereby improve the trade balance. Okay, because you don't need to have a material goods to make profit now, right? You can do it by just any exports for that matter. Next, that is about depreciation, what consequences it will have. Here now we will learn about an appreciation which will have the consequences, the following consequences on real economy. An appreciation of currency raises the prices of exports and therefore the quantity of exports would fall, right? Since imports become cheaper, we may expect an increase in the quantity of imports. Combining these two factors together, the domestic aggregate demand falls, and therefore economic growth is likely to be negatively impacted. Okay. Bizarre, isn't it? Because we always learned that a currency appreciation will lead to better impact on the economic growth. But the thing is about the term, in the long term, it will. Okay. But in the short term, the economic growth will be hindered when a currency appreciates. Okay. Uh, Negatively impacted, I must say, not hindered. Okay. Because it is only in the short term. And then the outcome of appreciation also depends upon the stage of the business cycle. If appreciation sets during recessionary phase, a result would be further fall, isn't it? First of all, there is recession, and over that, because of currency appreciation, now what will happen? The demand the aggregate demand will fall again. So it will be double, down the uh, bad impact. Next, an appreciation may cause a reduction in the level of inflation and all that. Yes. With increasing export prices, the competitiveness of domestic industry is adversely affected. Okay. Because, export prices, if it increases beyond a particular level, then your demand, your product, the demand for your product in the international market will go down. Right. Next, increasing imports and declining exports are liable to cause larger deficits and worsen the current account. However, the impact of appreciation on current account depends upon the elasticity of demand for exports and imports. Okay, so you have to check the elasticity also. For example, countries like Gulf countries, okay, whether their currency depreciates or appreciates, right? Their exports of oil cannot stop because that is one of the major exports with which they make money. So if the demand for your product is inelastic and your supply is also inelastic, okay, then there is a bigger problem. You need to figure that out. That is why most of those countries which have this kind of dependency, they go for fixed rate regime and not for floating rate. And then loss of competitiveness will be insignificant if currency appreciation is because of strong fundamentals of the economy. This is what I was talking about. If currency is appreciating because of the strong fundamentals, that is the good policies which are put in place, then the loss of competitiveness is insignificant and it's only temporary. That's what the point is telling us. So with this, we have finished the revision of the unit 4 of chapter 4, which was the last part we had to do. Now I want to tell you some things about how to go about the exam preparation for this time. Okay, that is you are attempting the exam in the next month, that is May 2022, and how you should be going about economics for finance. I understand that the subject economics for finance is the last subject of your entire curriculum, and by the time you get here, it's going to be the so many days, either eighth day of your struggle or the 16th or 18th day of your trouble, depending upon the whether you're writing one group or two groups. Now, all I can say is you are stressed, you are physically exhausted, mentally exhausted, and all that. So, what I want you to do is that economics for finance, keep it a constant subject for let us say 1 hour every day, right? Don't give it much time, 45 minutes to 1 hour, right? Go through the notes, and if you are students, of course, you will be going through the classes and you'll be trying to revise, right? And especially the notes which we are provided, go through that, right? And compare that with the textbook, which is given by the textbook, right? See if there are any new things which are there, mostly not there, right? All the things which are covered in the classroom scenario, we have covered the first chapter, chapter especially, we have covered it in so much depth that we have solved like so many sums which are not there in the textbook, and we have tried to give a conceptual clarity there. So be confident. That is point number one. This is just an exam, nothing else. And the economics for finance is not as strict as auditing when it comes to correction. Okay, where the terms, the terminologies, if you write the key terms, right, you will get marks in economics. Okay, you don't have to frame sentences according to the necessity. Okay, that becomes very difficult. Usually you'll have to do that in audit and the law. uh, but in economics for finance, there is a level of independence which you can use, and these subjects are easily understandable provided you concentrate in those 5 6 minutes. You will get the concept right, and once you get the concept right, everything becomes easier. and you have prepared over several months and you have given your best, right? So then it's all about, being confident in those 3 hours of examination and writing that, right? So once you finish the classes, you'll finish this one round of revision. After one round of revision, I wanted to go through a second round of revision where you will just read. And thirdly, you will have to take all the RTPs out, okay, of the previous examinations. You have to take the RTPs, you have to take the mock test papers. Everything is available in the institute website. You don't have to go anywhere else. Right? Don't refer to anything else. Right? And RTPs, mock test papers. Okay, these two are the major source. Right? And your textbook questions, what are they? Like these three parts, if you cover, and however our classroom material you are going to cover the illustrations. So these four things, that is more than enough, right? That is more than enough for you to literally score 30 out of 40, right? And then if you get another chance to revise, then your scoring will only go above, okay, the 30 marks. And out of 40, there are students who have called us and called me especially and told about how they scored higher marks in economics, because economics is more like a like bonus marks for you in your 8th chapter, because the first part of your paper, which is going to be financial management, is practical paper, and the marks distribution will highly depend upon whether you'll get to the answer or not, right? But economics is not like that. Here you can score like 75% of the awarded marks easily by understanding the question properly. So I want you to do that. Then after that, one mock test where you will understand, and where you'll understand where you stand, right? So you'll be able to write properly and you can compare your answers with the suggested answers. And with that, you should be good for economics for finance. There is nothing to worry about this subject. This is the easier subject. It's a very light subject for uh, only it gets a little bit complicated around the third chapter. Okay, but if you can manage that conceptual with the conceptual clarity, then there is nothing like it. So here is me wishing you all the very best for your examination. Perform really well. uh, we as teachers want nothing but your success, and it only uh, you know lightens our mood, okay, when our students perform well in the examination. So study well, don't waste time, and there are like very precious moments, precious days which are remaining in ahead of you. So do well in your examination, right? And we'll see you after the exams. I hope all of you clear. All the best. God bless you.